Here's what you do. Forget about trying to time the market. Forget about trying to avoid those 1 day, 1 week, or even 1 year swings. You want to focus on dollar cost averaging. All these words are a definition of dollar cost averaging that I got off the web. It's actually very simple. It's just the process of adding some amount of money to your investments in regular intervals and being disciplined about it. For example, once a month or once a year or whatever, you add some amount of money to your investments. You do the same amount each time on a regular basis. What's so great about this is that it takes the emotion out. It forces you to invest instead of trade. You buy regardless if the investment is up or down, if it just shot up 5% that day or if it cratered 10% that morning. Because again, it's more about where the price is 20 years from now. With zero commission ETFs, and by the way, there are more and more of these available all the time, you can buy $20 worth or $2,000 worth and it still costs nothing. Many brokerage firms can set this up for you automatically so you can stay disciplined, which is the key. This table shows an example of how your dollar cost averaging helps you invest. This is based on a hypothetical investment of $100 a month in some investment. Look at the share price and shares bought columns. In the first month, the price is at $20 a share, so $100 will buy you 5 shares. In month 2, the share price has dropped to 18, so another $100 contribution will now buy 5.56 shares. You're buying more shares when the price is low. When the price is higher, your $100 buys less shares. So you're not buying high and selling low, you're reducing your average cost per share over time. There's also the magic of compounding. Compounding simply means that any dividends or capital gains from an investment are reinvested back into the investment. You buy more shares with the money that the investment pays you. You don't have to put any more money into the investment yourself if you don't want to. It grows all by itself. Dollar cost averaging and compounding are 2 extremely powerful tools that are easy and allow you to build wealth over time. And that's the big point right there, time. Building wealth over time. This is what allows you to have a nice retirement or provide for your family. Yes, the stock market does go down. Nothing I've said in here will protect you from market crashes. It sucks when the market goes down. But if you follow the plan I've laid out in this presentation, even with all the market crashes that have come and that are sure to come, you'll still be much better off than if you had done nothing, buried your money in the backyard, or kept it in a savings account your entire life. So let's summarize. To retire on Easy Street, you're going to need to invest wisely. Determine the asset allocation that's right for you. Buy low-cost mutual funds, index funds, or zero commission ETFs in a brokerage, retirement, or 401k account. Dollar cost average and compound your investments. Resist trying to time the market, except with your play money. Follow the tips and tricks that I'll recommend in a couple of minutes. And that's it. The easy way to Easy Street. Follow these steps, keep some cash on hand for emergencies and expenses, and you'll be doing just fine. Okay, Section 4 is on web tools. As investors, we have a huge advantage over those that came before us. We have the internet. Information that used to be really hard to get or cost a lot of money to get is now free and immediately available on the internet. I'm going to show you some of my favorites, but by all means I encourage you to look around on the web yourself. A site I like to use is Yahoo Finance. Here on this one page I can see the latest headlines, where the major market indices are at, I can get stock, fund, and ETF quotes, and do research on the various different investments. To check out this site, go to finance.yahoo.com or search Yahoo Finance in whatever search engine you use. If you type a stock or fund symbol into the Get Quotes box, you'll get all kinds of good info on that stock or fund. Don't be intimidated by the sheer amount of information. A lot of it is overkill for what most average investors like me, and maybe you, are looking for. Here are a few things that I like to look at. This is the profile page on a small cap growth fund. I didn't talk about the differences between growth and value funds, but it's not that big of a deal, and I suggest you research it yourself if you're interested. If you have a large amount of money in your portfolio, you might decide you want more buckets than the 7 I mentioned earlier. You may want a large cap domestic growth bucket and a large cap domestic value bucket. There are low-cost ETFs available for all these specific buckets, and you can do your own research on them on Yahoo Finance as well. Anyway, so on this profile page, you see the name of the fund and some stats on it. This yield stat is good. You can think of it as a dividend. I'm not going to get into yields and dividends too much here, but you can find plenty of info about it on the web. It's part of the compounding I talked about a slide or two ago. This style box tells you what bucket this fund would fall under. These aren't 1000% accurate at all times, but can be used in general. The fund summary talks more about what the fund is designed to do. In this case, you can see that the fund typically puts 80% of its holding in small cap stocks, and it's not all domestic companies. Some amount is actually going into international companies as well. And this section gives you information on the expense ratio and fees or loads associated with the fund. Very important information. If you see a fund with fees or loads, go look for other comparable funds before you decide to buy anything. You can do that under the Research tab on the main page of Yahoo Finance. You'll also see some info here about who the fund manager is. To some folks this is important information, but I don't know any of these people from my grandmother, so I don't pay it much attention. The basic chart page is another page I like to look at. Here you can see the performance of the investment over time in different time frames. You can compare the stock or fund against other stocks or funds, or market indices or whatever. Just type the name of what you want to compare into this box. This is a good place to compare a mutual fund that you're thinking of buying with its index to see if it's beating it. Just make sure you pick the correct index. You can't really compare the performance of a small cap mutual fund with the S&P 500 index as I'm showing here. You should compare apples to apples to decide what apple to buy. Or you can compare apples to oranges to see if you should buy apples or oranges. Is that a bad analogy? What I mean is, you can compare a small cap fund against a large cap index to see which has been performing better. This tab over here that reads Holdings is another good one. This will show you some of the stocks that are in the fund or index. You can compare various funds to see what they have in them. A lot of the time, I've found that one fund pretty much has the same holdings as the index. It just has a higher expense ratio for some reason. You can show the chart in line form as shown here, or in bar form. The bar form shows you how the price moved during the day. This only works with stocks or ETFs, however, since funds only price once a day at the end of the day. Lots of websites have stock charts and data, not just Yahoo Finance. A lot of online brokerage sites provide this information as well. I have my accounts with Fidelity Investments. I highly suggest you open an account online with a discount brokerage house. Back in the olden days, you had to call someone on the phone to tell them to buy a stock for your account. Now you just click a button, although I'm sure you could still call if you want to. You also had to pay a much higher commission because the transaction was harder to perform. It's much easier and faster now, so commissions are much less. I'm paying $7.95 each time I buy or sell something. That's a lot if you're only buying $100 worth of something, so I don't recommend it for dollar cost averaging. Remember that many ETFs can be bought for zero commission. Ask your broker or look around on their website to find them. Fidelity's website has a search box in the upper left-hand corner. Do a search for no commission ETFs and you'll get the whole list. Anyway, so here's some good information that Fidelity and I'm sure most other brokers give you. I've tried to be good about keeping my asset allocation where I want. As we saw previously, there was a small cap fund that actually had some international stocks in it, which can throw off my international asset allocation if I'm not careful. So this page breaks down my entire portfolio and tells me what I have. It breaks my portfolio down into large cap versus small cap and mid cap and shows me what sectors I'm in and compares that to the S&P 500. Sure would have been helpful back in '99 when I had way too much of the technology sector in my portfolio. I can also add my bank account or my work 401k account to this screen so that I can analyze my entire portfolio as a whole. So these are just some of the cool things on the web that you can use. First step though is to open an account. I'll recommend Fidelity as I find their site easy to use. I also like them because they don't try to sell you things. They don't care what funds you buy or how often you buy them or anything like that. You can call them up, tell them what buckets you want, what investments you want to buy, and how much money you want to put into each, and they can help you set that up if you want. And finally, Section 5. There's a ton of things I haven't talked about in this video. I didn't want to make it too complicated because really, just doing what I've talked about as far as the asset allocation, not buying heavily loaded funds, and dollar cost averaging, those simple things alone will put you way ahead of the game compared to those that are just keeping their cash in a savings or checking account. But I do want to make sure I touch on a few important tips and tricks, things that I've learned over the years that I think are crucial, things I wish someone would have told me, or maybe told me twice, hint hint, in case I was too stubborn to listen the first time. So here we go. This one I've already said. Always look for no-load mutual funds first, and compare expense ratios when choosing between funds. Every so often, check your current allocation to see how it compares to where you were before and where you said you'd be by now. 401ks are great. Don't let people at work tell you any different. At a minimum, put however much your company will match. Even if they're only matching 50 cents on the dollar, that's still 50 cents of free money. Some 401ks have vesting periods. Don't worry, even if you quit before all the money in your account is vested, you'll still get all the money that you contributed back when you leave, so there's no worry about losing that money. Watch CNBC or read the Wall Street Journal, and you'll see that half the articles say, "Buy right now," and the other half say, "Sell, we're all doomed." Nobody consistently knows where the market is going in the future. And again, you'll hear lots of people talk about how the market signals and this and that. While it's interesting and often entertaining, unless you're sitting at a computer all day and are allowed to trade stocks without getting fired from your real job, this information is kind of useless. All it does is usually scare people into selling too soon or buying too early. This goes for the guys selling those black boxes too, those computer programs that supposedly tell you exactly when to buy and sell. Always maintain an emergency fund in cash. Keep about 3 to 6 months of expenses as liquid as possible. Create a simple budget to track your expenses if you don't know how much money you're going to need to survive 6 months if you lose your job. This is important stuff to know. Don't start investing until you have your cash bucket filled up. Dividends and capital gains are taxed heavily, as are profits if you sell and that investment has gone up in price. Once you've gotten yourself started, or better yet, before you actually buy any investment, you may want to check into opening a brokerage account and a tax-advantaged account, like an IRA. Or you can start with a brokerage account and then eventually roll part of that account into an IRA. Here's a handy chart that I can email you, or you can find if you search around on the internet. Investments that have high yields, such as a high-yield bond or a stock that pays a fat dividend, are great to have in tax-advantaged accounts because you don't have to pay the taxes on that income until you withdraw the money after age 65. I own stocks and some mutual funds in my IRA, and I have index ETFs in my brokerage account. I think this is a good balance. There's lots more info about this online, or you can talk to an advisor. The bottom line is, if you're going to mix index funds or ETFs with managed funds and stocks like I've talked about doing, then it would be good to own the managed funds in your IRA or 401k and the index ETFs in your brokerage account.